All right, let's dive into January 2026. This was a month of, well, pure contradiction. On one hand, you had major indices touching all-time highs, but if you looked under the hood, the market's plumbing was, frankly, springing some major leaks. It was a real puzzle, and in this breakdown, we're going to piece it all together. And that brings us right to the central question we all had to ask ourselves. Were we looking at a genuine, durable bull market, or was this whole thing just a house of cards? I mean, the data we got in January was pointing in two completely opposite directions. The signals were profoundly mixed, to say the least. And this slide right here, this captures that paradox perfectly. On the left, you've got the big US indices, even the small cap Russell 2000, knocking on the door of all-time highs. But then look to the right. At the exact same time, we saw a massive outflow of over $43 billion from global equity funds in a single week. So you have to wonder, right? Why was so much smart money heading for the exits while the music was still playing? What on earth was pulling the market in these two opposite directions?
Well, the first force, and you could argue it was the most powerful one propping everything up, was this deep, deep conviction in the AI revolution. And this wasn't just about a good earnings season. No, this was a fundamental belief that AI was a true, long-term, structural shift in the entire economy.
This quote from some of the market commentary at the time just nails the sentiment. The key words, you see them right there, are structural, not cyclical. The market wasn't thinking, oh, AI is having a good quarter. The thinking was, AI is a permanent, game-changing shift. And that idea, that bedrock thesis, is what allowed investors to stomach some of the incredible short-term volatility we were seeing. And this thesis wasn't just some nice story people were telling themselves. It was being backed up by some seriously hard numbers. Just look at Taiwan Semi, the bellwether for the entire industry. They posted a stunning 35% year-over-year jump in their Q4 profit. This was the tangible proof. This was real money showing that AI demand was translating directly to the bottom line. But here's where it gets really interesting, because this wasn't a case of a rising tide lifting all boats. Not at all. While TSMC was just crushing it, posting record profits. Take a look at Intel. Now, they actually beat their Q4 estimates, which you'd think is good news. But their forward guidance for Q1, an absolute disaster. They projected 0 earnings per share, and the market just hammered them for it. This really showed that it was a stock picker's market focused only on the true winners in this AI arms race. So while you have this strong structural AI narrative providing a powerful tailwind for the market, it was running headlong into a hurricane. And that hurricane was the second major force of the month, completely unpredictable geopolitical whiplash, driven almost entirely by US trade policy. And nothing captures this better than what we now call the Greenland tariff saga. I mean, this was a masterclass in policy-driven volatility. In just a handful of days, the market gets absolutely whipsawed. First, a sudden tariff threat sends the S&P down over 2%, and then just as quickly, a frameworks deal is announced, and boom, a massive relief rally sends the Dow surging nearly 600 points. Volatility like that doesn't just make you rethink risk, it forces you to redefine it completely. You know, this period of just extreme policy uncertainty actually gave birth to a new term in the analyst's lexicon, the sell America trade. Now, this wasn't about being bearish on the U.S. economy itself. It was more of a strategic retreat, a move away from any U.S. assets that were seen as vulnerable to the whims of these unpredictable policy announcements. It was, in essence, a flight from policy risk. So what happens when a powerful long-term growth story like AI collides head-on with extreme geopolitical risk? Well, the capital doesn't just disappear. It moves, it rotates, and tracking where that money went is what reveals the true market sentiment of the month. And this chart really shows that the rotation away from risk was a truly global phenomenon. Sure, the US saw significant outflows, nearly $17 billion. But that number was completely dwarfed by the historic capital flight we saw from China. We're talking almost $50 billion in a single week. This wasn't just some minor portfolio adjustment. This was a massive global reallocation of capital. So the big question is, where did all that money end up? Well, it was seeking different kinds of safety and opportunity. We saw a lot of it flow into broader emerging markets, which actually posted a 5th straight week of gains. Of course, it went into the traditional safety of precious metals, pushing gold to new records. But what's really interesting is that it also rotated within the US, away from the international megacaps and into domestically focused small caps, and also into classic defensive sectors like consumer staples. And this data table just makes that rotation crystal clear. I mean, look at this year-to-date divergence by the end of January. The Russell 2000, which represents U.S. small caps, was up over 7%. Meanwhile, the NASDAQ 100, home of all those mega-cap tech darlings that absolutely dominated 2025, was barely positive. It was a clear, tactical shift away from the global giants and toward companies that were more insulated from all these international trade disputes. So, after a chaotic month like that, what's the big takeaway? It pretty much forces us to toss out the old playbook and write a new one for how to navigate the markets in 2026. And here it is, your new playbook, broken down into 4 key rules. First, guidance is king. As the Intel debacle proved, a historical earnings beat means absolutely nothing if the future looks weak. Second, you have to price in policy volatility. This isn't a temporary bug, it's a permanent feature of this market. Third, follow the flows. Capital rotations are probably the clearest signal we have right now of where true conviction really lies. And finally, number 4, diversify tactically. The era of just blindly piling into mega-cap tech is over. In this environment, small caps and emerging markets offer some crucial advantages. And all of that leaves us with the big question for the rest of the year. Was all the chaos we saw in January just a short-term knee-jerk reaction to a few crazy headlines? Or did we just witness the opening moves of a major, year-long structural shift in how global capital gets allocated? That right there is what we'll all be watching for.